Hi guys, so this is the next video in the chapter 3 series. So today we look into the monetary policy. So monetary policy is one of the tools that a government uses to influence its economy. So the government uses its authority to control the money supply and the availability of money and inflation in such a way to influence the overall level of economic activity in line with the government's objectives. So the Central Bank of Sri Lanka executes monetary policy on behalf of the government. The main instrument that the government uses to control the money supply is interest rate. The CB identifies this as also standing facility rate. So standing facility rate is divided into three: standard deposit facility rate, standard lending facility rate, bank interest rate. So let's look into this briefly. Standard deposit facility rate. So this is the interest rate paid when the commercial banks and the primary dealers invest their surplus funds in government securities. Standard lending facility rate. This is the interest rate charged by the central bank when commercial banks and primary dealers obtain funds by pledging government securities that they hold in the central bank. So in simple terms, if we are to understand SLFR and SDFR, these are the facilities provided by the Central Bank of Sri Lanka for commercial banks and primary dealers to either obtain funds from the central bank or deposit excess funds to the central bank. So if a commercial bank, in order to meet any urgent money requirement, can obtain a short-term borrowings from the central bank. In order to obtain that loan, they have to pledge the government securities that they hold. So the rate at which the loan is borrowed is known as the standard lending facility rate. On the other hand, a commercial bank or a primary dealer could also invest their excess fund in a short time period at CBSL. So at the rate in which they receive the return is known as the standard deposit facility rate. So a standard deposit facility rate and a standard lending facility rate acts as a corridor where the standard deposit facility rate becomes the minimum rate at which the return is received, and standard lending facility rate becomes the maximum rate at which the interest is paid. This corridor, which is also known as the standing rate corridor, is implemented in order to prevent large fluctuations in the short-term interest rates in the market. So with COVID-19 and its impact to the economy, CBSL has revised and reduced the standard lending facility rate and the standard deposit facility rate. So do visit their website to find more information on the latest rates. The next instrument that is used is the bank interest rate. So this is the interest rate that the CBSL as a final loan provider charges from the commercial banks who have obtained loans for liquidity issues. When CBSL increase the rate, then the commercial banks too increase their interest rate. So interest rate is the cost or charge for borrowing, so which is decided by the central bank. Interest rate and money supply have a negative relationship. So practically if we see, if the interest rate is high, the people or business will be reluctant to obtain loans, since they would have to pay higher amount of interest apart from the capital repayment. At this point, banks will also pay higher interest for deposits. So people and businesses tries to earn higher interest income by depositing their funds. So at this point, the money supplies tend to reduce. This would be the other way around if the interest rate is decreased. So simply, from the point of view of an individual and a business, if the interest rate increases, borrowings will decrease while lending increases. And if the interest rate is decreased, then the borrowings will increase while lendings will decrease. So that's it with this video guys. Please do like and share to learn and let others learn. Thank you.